They deployed their strongest weapon without hesitation, a sudden 15% margin hike engineered with one clear objective: to crash the silver market overnight. This was not a warning shot. It was a kill shot, or at least it was supposed to be. Yet when the dust settled on January 13th, 2026, something extraordinary had happened. Silver was not down. It was up nearly 4.5%. The banks attempted to suffocate the rally, and the market responded by moving higher, almost mockingly. That alone should have stopped people in their tracks. But what followed was far more important and far more dangerous. As the price pushed toward $89 per ounce, something else occurred beneath the surface. Nearly 1.7 million ounces of silver abruptly jumped the delivery queue inside the futures market. Industrial giants began paying premiums to secure immediate supply. And deep within the mining sector, two words started circulating quietly, nervously, and with growing urgency: force majeure. Those words carry legal weight, and if they are spoken officially, they have the power to collapse the entire structure of the paper silver market. The metal is disappearing, and the squeeze is no longer theoretical. It has begun. Welcome to CSC Alert. This is not entertainment. This is a strategic intelligence briefing for decisions that actually matter. And before we go further, let me ask you something. If you have spent decades in business, if you have watched cycles rise and fall, if you understand that real wealth is built on data, timing, and foresight rather than hype, then you already know how valuable information is when it arrives before the crowd notices. That is exactly what we deliver here. So take a moment and subscribe, not because it sounds exciting, but because what unfolds next may permanently change how you view the precious metals market. And while you're here, leave a comment and tell us where you're watching from. New York, London, Dubai, Hong Kong, Singapore. We want to know where serious capital is paying attention. Now let's break down what just happened in the silver market and why the so-called double squeeze has left the banking system with no viable exit. For more than 4 decades, the silver market operated under a single, unspoken rule. If prices rose too quickly, the Chicago Mercantile Exchange would intervene. They would raise margin requirements, force traders to post more cash, and trigger a cascade of liquidations. This tactic worked repeatedly. It crushed rallies, broke momentum, and reminded speculators exactly who controlled the game. History is filled with examples. In 1980, the Hunt brothers attempted to corner the silver market. The exchange changed the rules midstream, raised margins dramatically, and forced liquidation. The result was total destruction. In 2011, silver surged from $30 to nearly $50 in a matter of weeks. Speculative enthusiasm exploded. Then the CME struck again, implementing 5 margin hikes in 9 days. The rally collapsed and silver fell violently back toward 30. In 2020, the same pattern repeated. Each time silver showed strength, the exchange pulled the same lever. Over time, this tactic earned a name: the nuclear option, the ultimate kill switch. On Monday, January 12, 2026, that weapon was deployed once again. Without warning, the CME announced a 15% increase in margin requirements. Traders suddenly needed nearly $6,000 more per contract. The intent was unmistakable: break the rally, scare leveraged players, force selling. History suggested silver would collapse immediately. Analysts predicted a retreat toward $80 or lower. The banks believed control had been restored. Then Tuesday morning arrived. When traders opened their screens on January 13th, they saw something that had never happened before. Silver was not falling. It was not even flat. It stood at $88.95, up nearly $4 overnight. A 4.5% gain immediately following a punitive regulatory strike. The assassination attempt had failed. For a brief window of roughly 4 hours after the announcement, the strategy appeared to work. Silver dipped to around $83.50. Algorithms triggered sell orders. Weak hands exited. The banks watched calmly, confident the familiar script was playing out. And then something completely unexpected happened. Buyers stepped in. Not retail traders chasing momentum. Not leveraged speculators gambling on charts. These buyers were different. Someone bought silver aggressively at 83.50 knowing full well a margin hike had just been imposed. That behavior violated every rule of conventional futures trading. Margin hikes scare speculators. They do not inspire buying, unless margin requirements are irrelevant to you. These buyers were paying cash. They intended to take physical delivery. They planned to remove metal from the exchange permanently. For them, the margin hike meant nothing. They were converting currency into a strategic resource, not playing a paper game. The rebound was violent. Within 24 hours, silver surged from the lows back to nearly $89. The chart formed a textbook V-shaped recovery. No hesitation, no grinding consolidation, just raw upward force. The message was unmistakable. The paper market had lost its leverage. Margin hikes only affect leveraged traders. They do not affect global manufacturers building battery plants. They do not affect central banks accumulating reserves. They do not affect solar producers securing long-term supply. In fact, these entities welcome margin-induced dips. Every forced sell-off becomes a discount on inventory they must acquire anyway. The exchange unintentionally put silver on sale for the very buyers draining its vaults. By the time silver approached $90, the reality had set in. The most powerful suppression tool in the system no longer worked. The question became unavoidable. If margin hikes fail, what comes next? While headlines focused on price, a smaller group of analysts was watching something far more disturbing. They were studying the internal mechanics of the futures market, particularly open interest across delivery months. Under normal conditions, these numbers follow predictable patterns that have remained stable for decades. But the data released that week showed something unprecedented. The pattern had reversed. In a typical market, traders roll forward. As a delivery month approaches, speculators sell the near-term contract and buy a later one, pushing delivery into the future. This keeps metal from actually leaving the system. But the data showed the opposite. Traders were selling March contracts and buying January and February contracts. They were rolling backward in time. Open interest in March dropped by roughly 450 contracts, while January and February saw increases. Net result, approximately 355 contracts jumped the queue into immediate delivery months. Each contract represents 5,000 ounces. That's nearly 1.8 million ounces demanding earlier delivery. This behavior is not speculative. It is defensive. Rolling backward costs money. Storage costs money. Insurance costs money. You only accept those costs if waiting feels more dangerous than paying. The backward rolls signaled a collapse of trust. Buyers no longer believed future delivery was guaranteed. Delivery notices reinforced the message. 170 traders stood for delivery in January alone. Instead of exiting positions, they demanded metal. Even as deliveries occurred, new buyers kept entering. The system was trying to ship silver out while demand surged in. A logistical traffic jam was forming. Each buyer jumping the queue made the next buyer more nervous. If one industrial giant secured supply early, competitors felt compelled to follow. Fear spread rapidly through supply chains. These entities had access to shipping data, refinery contacts, and internal inventory reports. They knew the float was gone. Historically, shortages could be masked by moving metal between financial centers. If New York ran low, London supplied it. If London ran low, Zurich stepped in. But this time, the shelves were empty. Shanghai had absorbed loose inventory. There was nothing left to move. Waiting until March meant risking cash settlement. And cash settlement is useless to manufacturers. You cannot build batteries, solar panels, or vehicles with wire transfers. So they paid the premium and took delivery while they still could. At the same time, another reality was emerging. High prices were not increasing supply. In fact, production was stagnating or declining. The reason lies in how silver is actually produced. Over 70% of global silver supply comes as a byproduct of mining for other metals like lead, zinc, and copper. When demand for those metals slows, mines cut output, and silver production falls with it, regardless of silver's price. This creates a perverse inversion. Higher silver prices do not trigger more silver production. They coincide with less. The textbook supply response fails entirely. Worse still, much of the silver that is being mined is never reaching public markets. Industrial buyers are bypassing exchanges altogether, locking up future production directly at the source. Miners are offered spot plus premium contracts with guaranteed offtake and no counterparty risk. From the miner's perspective, it's perfect. From the market's perspective, supply becomes invisible. Public inventories drain while private stockpiles grow. To traders watching warehouse data, it appears as though silver has stopped being produced at all. Political risk compounds the problem. Governments are beginning to question why strategic resources are flowing abroad. Export restrictions, higher taxes, and nationalization discussions are gaining traction. Each whisper adds another dollar to silver's premium. And then there is force majeure. Miners are quietly preparing legal escape clauses on contracts with bullion banks, citing inability to deliver due to prior commitments. If invoked, short sellers are trapped. They cannot source metal from mines. They cannot source it from vaults. They must buy from private holders at whatever price is demanded. Even if miners wanted to expand, time makes it impossible. A new mine takes a decade or more to reach production. The market needs silver now, in January, February, March. In that gap, only one variable can adjust: price. At $89, demand is accelerating. Therefore, the price is still too low. Traditional technical analysis is useless here. Silver has entered pure price discovery. The more meaningful metric is relative value. Gold is trading around $4,800. The gold to silver ratio remains historically distorted. At roughly 52 to 1, silver is still deeply undervalued relative to gold's monetary role. A reversion toward historical norms implies prices far above current levels. Triple-digit silver is no longer speculation. It is arithmetic. Crossing $100 changes everything. Media attention explodes. Public interest surges. Psychology takes over. Volatility increases dramatically. Banks may attempt further interventions, higher margins, trading restrictions. Each attempt will create temporary dips, and each dip will be met by buyers who understand the shortage cannot be regulated away. Selling silver for fiat during such a moment carries immense risk. History shows that those who exchange hard assets for collapsing currency regret it deeply. The smarter trade is asset for asset, metal for land, metal for income-producing businesses, metal for infrastructure. That moment has not arrived yet. The squeeze is still building. The vaults are draining. The banks are trapped. The miners cannot respond. Price is the only release valve left. This is not a theory anymore. It is a collision between paper promises and physical reality. Welcome to the age of real money.